This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are poised for gains to end a roller coaster week after signs of US labour market resilience lifts Wall Street. Swaps traders are further trimming bets on aggressive Fed cuts this year. China's July price data out today set to show consumer demand still in the doldrums and factory deflation deepening for the first time in 4 months. Plus, in our exclusive series, taking you inside the Adanis Group, we ask the boss of their consumer businesses what they've learned from the turmoil following the Hindenburg report.
Now, from an optic point of view, we've become very clear that we go out and communicate more transparently about the structures and about things like the finances.
And Haidi, of course, the overnight session that we saw and that gain in the Wall Street equity markets, not to mention, of course, the fall in treasuries as well, really propelled by those U.S. initial jobless claims declining by the most in almost a year, sort of giving a little bit more reassurance to traders that perhaps we are not headed towards that rapid deterioration and cooling of the labor market. Perhaps we're just returning to the pre-pandemic trend rather than a hard landing, as was feared. And of course, it's really all about watching those economic numbers out of the U.S. to make sure that we're not headed into a recession and that the Fed is not late to the game.
It's also about China as well, Shery, right, in terms of this engine of global growth that it used to be. And we are getting the CPI and PPI numbers as well. And we're expecting to see sort of further weakness there. And that's not going to add much positive sentiment when it comes to risk appetite for Chinese assets. These are the expectations for the July price data expecting to be showing that deflation risk just increasing. Very much consumer price inflation likely to inch up from the very low levels, I should point out, in June. But deflation in factory gate prices, that's the one that we're probably more concerned about, likely deepening for the first time since March. Declining commodity prices hasn't helped with that. A less favourable base effect hasn't helped with that either. And we are watching sort of some of the implications for the markets, including what we've been seeing across China's bond markets, right? Authorities, they're widening the fight against that record bond rally. The targets are sort of widening. Big banks seen selling 7-year notes to pull up yields. We're seeing local authorities suspending some lenders from trading bonds. So that's going to be a key point to watch as we get into this last session for the week in Asia, Shery.
And it's all really about central banks around the world, right? And those economic numbers out. Right now, as we speak, we got the rate decision from the Peruvian central bank, and they've unexpectedly cut rates after holding steady for the last 3 meetings. This, of course, coming at a time when Peru is looking at core inflation and the central bank seeing that those concerns that inflation remains very high, perhaps not as warranted, and that the economy is already growing faster than expected. So it seems that the Peruvian central bank is now sort of shrugging off some of those concerns, and right now they've cut the reference rate to 5.5%. Peru now seeing inflation around 2%, with core inflation starting to cool down, and that those prices are less persistent in their gains in the month of July. So really all about those economic numbers for these central bankers trying to figure out when the right time would be for the easing cycle that might get more aggressively underway around global central banks. But take a look at how we're setting up for the Asian session, because of course it's really all been about the BOJ as well, right? I mean, the BOJ is going in a completely different direction with that hike that we saw last week, and that market turmoil that followed. The Japanese yen continued to weaken in the overnight session. So we have, of course, been digesting the BOJ summary of opinions after the last decision to hike rates, and it showed that the central bank will keep its policy accommodative. The Nikkei fell in the previous session. We're seeing some signals of gains for today's session. Take a look at A50 futures also having closed to the upside. And we continue to watch the carry trade and its unwinding, and JP Morgan saying that we might be 75% of the way there. Of course, that's had really big repercussions for markets around the world. But take a look at how U.S. futures are coming online in the Asian session. The S&P 500 just saw its best day since November of 2022. We mentioned those initial jobless claims declining by the most in nearly a year, and we'll continue to watch the labor market cooling as well as perhaps some Fed speak. We got from the Richmond Fed president also saying that the Fed has time to assess whether the U.S. economy is normalizing. Our next guest says the Fed has lots of room to cut rates. Let's discuss this with Young-Yu Ma, Chief Investment Officer, BMO Wealth Management. Young-Yu, do you think the Fed is not behind the curve as was feared earlier in the week?
Hi, Shery. Great to be here. Well, we do think the Fed may be a bit behind the curve, but the Fed has a lot of latitude to cut rates and even do so aggressively if it sees signs of labor market weakening. Today's weekly initial unemployment claims were, I think, the most watched weekly initial unemployment claims data point that I've ever seen. Really, there's so much uncertainty about which way the labor market is tilting. Traders were very much focused on the strength that we did see in this number, which was on the low side. So we think that the Fed has a lot of ability to cut rates. Inflation has come down a lot, allowing the Fed that flexibility. And we think probably by September, even though we won't see a lot of labor market softness, there will be enough pointing in that direction for at least the potential of softness that'll compel the Fed to cut rates, and we think by a 0.5 percentage point.
Of course, the concerns about the U.S. economy really sent the yen spiraling as well higher against the U.S. dollar, which led to those unwinding trades of the carry trade that's been so popular. How big of a risk is this still for the markets?
We think probably the most acute phase and the biggest risk is beyond us now. It's hard to assess how much is left of that unwinding, but I think the concerns really come in if the unwinding takes place at a time of market volatility and when other factors in the market are also driving that as well. So when everything comes together in that negative way, as it did earlier in the week and last week, when you really get a disruption. We think the worst is behind us, though, and there may still be some unwinding, maybe smaller hiccups, but the big part of that move is probably done with at this point.
Is the worst behind us when it comes to the structural slowdown story for China, or is this sort of the new normal that investors need to be contending with? I think it's interesting that you don't think any kind of big bang stimulus will necessarily come until possibly after November.
That's right. We think the Chinese government is probably biding its time a little bit to wait to see what happens with the U.S. elections and how it might have to respond to potential tariffs if former President Trump is reelected. But right now, we think there is softness. There's continued softness on the consumer side, the employment side, the credit growth side. You're just seeing it in many areas here. Is the worst behind us? I think if you think of this in terms of time, I think the worst is behind us. Are we clearly on an upswing in China? That's not clear at all. And there's probably further room to carve out the bottom before there's a meaningful turn upward. But a lot of time has been put in to purge some of the problems in the system in terms of the challenges of the property sector in particular. So we do think there's a slight cause for optimism in the sense that we're a long way into this already, even though we're still probably carving out the bottom.
And yet valuations remain very compelling, right? You say that you still have some optimism when it comes to the AI and tech trade at a time where investors are kind of losing patience with the amount of capex that we've been seeing poured into this sector, right? How do you look at the geopolitical risk in that sense? Are there better opportunities in Asia, perhaps?
Well, we do certainly see some opportunities in Asia, even outside of China. We see some opportunities in Southeast Asia. There are some countries that are going to benefit from some of the decoupling that's taking place between the U.S. and China. And that's really in the relatively early stages, we think. That's going to go on for some time, where investment's going to flow to certain countries in Southeast Asia, and probably in a pretty significant way relative to the size of their economy. So even though we're very positive on AI developments over the medium and long term, there's a lot of investment going in. Some of that will be capital investment across Southeast Asia as well. So that there are some positive things going on, certainly, but we think ultimately those benefits from AI are going to result in improved productivity for firms that find ways to implement AI and realize cost savings. So that's going to drive the ultimate investments. And we think that's a few quarters away, but we do think that is going to happen, and that's going to be a 2025 story.
Really great to have you with us, Yung Ma. He's the Chief Investment Officer at BMO Wealth Management. Coming up next on the Asia Trade, the CEO of the Philippines' biggest mobile payments provider, GCash, joins us live to talk about their plans to go public after securing investments from Japan's MUFG. Plus our exclusive conversation with Pranav Adani as he heads the Adani Group's most complex and high-profile project, the redevelopment of Asia's largest slum. This is Bloomberg. Let's get you the latest when it comes to the US presidential race as we count down to November. And Republican presidential nominee Donald Trump is pitching a series of debates now with Kamala Harris in September. Trump's team is offering debates on Fox, NBC and ABC. The Harris campaign says it's happy to have a conversation about additional debates beyond the one that already agreed to. Speaking with reporters at Mar-a-Lago, Trump criticised Harris for avoiding media interviews since securing the nomination. Trump also told reporters that the president should have some say over interest rates and monetary policy. Such a move would go against the long-standing practice of keeping the Fed independent from political actors. Trump has repeatedly complained about the issue and criticised Fed Chair Jerome Powell for being both a bit too early and too late on moving interest rates. Well, battleground states in this year's US presidential race are showing economic cracks that could prove a political obstacle for the Democratic candidate, Kamala Harris. That's the subject of today's Big Take. For more, let's bring up Bloomberg US economist Stuart Paul. And Stuart, you know, when you talk about the economy as being an election issue, this is not about, it's essentially not about kind of how the broader US economy is doing, right? It's down to these very specific swing states.
That's right. So these 7 battleground states are going to be these states that determine the outcome of the U.S. presidential election. They, if we're taking them as a single unified economic area, they account for about $4.4 trillion in GDP, roughly the size of Germany. They have a bit more of a manufacturing base than the rest of the U.S. as a whole. So they look a bit more 20th century or maybe even 19th century than the rest of the country. They're a bit whiter, they're a bit older, and frankly, they've experienced quite a bit more inflation over the past 4 years than the rest of the country as a whole. So when it comes to determining which president, or in this case, which candidate, current Vice President Kamala Harris or former President Trump, these voters trust to shepherd the economy forward, it's no surprise that in polling, we see President Trump is trusted a bit more as a steward of the economy by these swing state voters.
Which states would matter the most in this case when it comes to economic factors to contribute to the actual outcome in the U.S. elections in November?
Pennsylvania probably matters most. Beyond Pennsylvania, Michigan, Wisconsin, they're considered the blue wall states. They're must-win states for the Democrats, and they are definitely a bit more industrial than the rest of the country and even the rest of the swing states as a whole. Beyond those 3, we also have to keep an eye on North Carolina and Georgia. We need to keep an eye on Arizona. We need to keep an eye on Nevada, some more of these Sun Belt states. And those are the states where we've seen just a lot of inflation and home price appreciation. Under the Trump administration, the median household would have needed to just spend about 17 to 20% of their income to make monthly mortgage payments on the median home. Now that's up to about 30, 35% in some of these swing states, some of these Sun Belt swing states that have been so popular as a migration destination.
We've heard again from the former President Trump saying that he thinks presidents should have some say over interest rates. This is not the first time that he's expressed this kind of frustration that the executive branch doesn't have more say over monetary policy, right? To this end, and also the fact that, you know, he's a proponent of these pro-growth, pro-tariff, presumably pro-inflation, ultimately, policies. How much concern is there about the economic uncertainty following November or following January?
There's plenty of economic uncertainty wrapped up in who's going to be the next presidential, who's going to run the Treasury next, who's going to be suggesting budgets for the Congress next, and perhaps who's going to be using the bully pulpit to influence monetary policy makers next. I think that what's clear is that when we compare the two candidates, both are looking for ways to provide accommodative fiscal policy, whether that comes in the form of more deficit spending or whether it comes in the form of additional tax cuts to try to help consumers control more of their income and more of their spending. Both candidates favor industrial policy, Trump with a little bit less emphasis on green technology. When it comes to influence over monetary policy, though, at least it's the academic position that an independent central bank is probably the closest thing to a free lunch that you can find in economics. So I don't think that that's a dimension that Kamala Harris is going to be looking to compete with President Trump on. I think that she's going to be fine to let him try his best to pitch the idea that presidential control over monetary policy is some sort of a good idea. It's most certainly not based on the academic literature.
Stuart Paul, Bloomberg U.S. economist there with our big take for this week. You can actually read that full story on the terminal or by heading over to Bloomberg.com. And we were talking about some of the election political risks around the presidential election when it comes to the U.S. economy. And Haidi, it's really all about the economy, isn't it? Economic data and what the Federal Reserve will also do down the road. I mean, we saw the market gyrations just from a weaker than expected U.S. jobs report last week. Well, we continue to watch the labor market. Today, we got the initial jobless claims declining by the most in nearly a year, which led to the S&P 500 seeing its best day since 2022. What we'll be watching from now on is also what happens to these businesses that have been what people are calling labor hoarding. Remember that time when we had worker shortages everywhere during the pandemic? Well, businesses have been scarred by that. So they've really been keeping all of those employees that perhaps if we do see an economic slowdown, they will need to let go. And of course, we will be watching the U.S. unemployment rate to see what happens when it comes to those jobs.
Yeah, we're watching the property market as well, right? Obviously, here in Australia, there's so much pressure when it comes to mortgage holders with the RBA not sort of looking at easing in sight yet. But we are seeing in the US, these mortgage rates are starting to give some respite to mortgage holders. And in fact, that decline really does potentially then transfer through to purchasing power as well of households, right? And for would-be home buyers. We could also see these lower rates convincing more people to put properties up for sale. In the US, we've seen these mortgage rates tumbling to the lowest level in more than a year. The average for that 30-year fixed-year loan at 6.47%. That's the lowest since May 2023 and also came down from last week as well. After, of course, we saw earlier this year really it topping 7%. We've seen that pretty rapid and steady decline. So giving the housing market a bit of a boost. We've seen applications for loans to buy homes increasing last week for the first time in a month. Refinancing demand by one measure jumping to a 2-year high. And of course, it sort of follows along what we saw with 10-year Treasury yields as well, which took that slide after the jobs report in July. And of course, with all this talk to the expectation of further Fed easing, we could see those rates coming down even more. And turning to China as well, because July inflation data is due out a little bit later this morning. Our China correspondent, Min Min Lo, joins us now for more in Hong Kong. So, Min Min, we're continuing to kind of see at least the sort of price pressures in the doldrums for China.
That's right. Inflation still expected to remain soft in July. We're expecting the CPI to hover just above zero. The PPI, Producers Price Index, likely to contract for the 22nd straight month. So that decline in factory gate prices is going to keep cutting into profit margins for manufacturers. And we're seeing overseas demand for Chinese goods softening as well, judging from that weaker than expected print in the exports in July. Possibly U.S. recession on the horizon maybe, and then domestically you have consumers not really picking up the slack as well, despite the government rolling out these measures, the upgrading of that equipment program, as well as measures to boost consumption, those 20-point plan that the State Council rolled out. But it looks like, you know, the key barrier to consumption picking up is consumer sentiment still very weak. People concerned about income growth, concerned about home prices falling, the state of the economy as well, and that's really preventing people from opening up their wallets.
Yeah, especially when it comes to luxury goods. But what about luxury experiences and things that people can really enjoy?
Yeah, so this is a trend that we're starting to notice, that people are spending less on goods and more on services. So if you look at the first half of this year, retail sales of goods was up just over 3%, but sales of services, though, that went up 7.5%, and that's where we see a lot more upside potential as well. Because, I mean, if you look at the luxury goods brands like LVMH, they had not been doing very well in sales, but travel boom, you know, every time that national holidays take place, you're seeing people going to places, even if they don't have a lot of money to spend. They're going to the second and third tier cities. They're paying for experiences. They're buying sports equipment, trying to pick up a new skill. That's why that 20-point plan that the government rolled out to boost consumption, a big part of that is about nurturing service consumption, things like travel, dining, accommodation, services, childcare and elder care. And there is a lot more potential for growth because China's share of services consumption in GDP is only 50%. That's quite low compared to places like the EU and the US, where the share of services consumption is 75%. So a lot more room for growth there, and a hedge against industrial production, where we see a lot more headwinds in terms of potential tariffs and US recession as well.
Right, Bloomberg's China correspondent Ming Lo there with the latest on China. We do have more ahead on the Asia trade. This is Bloomberg.
I think you've got some time in a healthy economy to figure out whether this is an economy that's gently moving into a normalizing state that will allow you to, you know, in a steady, deliberate way, normalize rates, you know, and stick the landing, if I could use another balance beam analogy. Or, you know, is this one where you really do have to lean into it?
That was a Richmond Fed President Tom Barkin. And it's time now for morning calls ahead of the Asia trading day. JP Morgan strategists say U.S. stocks could be headed for more severe declines. That's if economic growth continues to decelerate and the Fed does not show urgency in easing monetary policy. Strategist Dubravko Leikos-Bujas adds traders' focus has now shifted from inflation to growth risks. This marks JP Morgan's first note to clients following the departure of chief global strategist Marko Kolanovic. Now, the world's biggest active bond fund manager says he's just about ready to start adding to Treasury positions. Daniel Iverson manages the nearly $160 billion PIMCO Income Fund. This is Bloomberg.
I think you've got some time in a healthy economy to figure out whether this is an economy that's gently moving into a normalizing state that will allow you to, you know, in a steady, deliberate way, normalize rates, you know, and stick the landing, if I could use another balance beam analogy. Or, you know, is this one where you really do have to lean into it?
That was a Richmond Fed President Tom Barkin. And it's time now for morning calls ahead of the Asia trading day. JP Morgan strategists say U.S. stocks could be headed for more severe declines. That's if economic growth continues to decelerate and the Fed does not show urgency in easing monetary policy. Strategist Dubravko Leikos-Bujas adds traders' focus has now shifted from inflation to growth risks. This marks JP Morgan's first note to clients following the departure of chief global strategist Marko Kolanovic. Now, the world's biggest active bond fund manager says he's just about ready to start adding to Treasury positions. Daniel Iveson manages the nearly $160 billion Pinko Income Fund. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
I do believe there's resilience in the U.S. economy.
We do not yet see any sign of having the economy move in recessionary territory.
There have been several calls for U.S. recession. In fact, they just turned out to be corrections with a resumption of growth.
I do think that we're getting a correction here after a very strong run on the markets, and that might be healthy.
We don't see a recession coming soon or coming. Actually, we think that the economy is still strongly set.
We probably all have to live with more volatility than we are used to. But overall, I think the trend is our friend and the trend is showing upwards.
Ahead of the elections, obviously, maybe the market is a little bit muted. But all in all, the United States was always a market which was quite resilient.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
The economy will chug along and we probably won't see a recession.
C-suite executives weighing in on the risk of a U.S. recession following a week of wild market gyrations. Take a look at the volatility that we've seen across markets right now. This is the setup for the open, and it could potentially be an up session with Nikkei futures gaining 0.3% at the moment. But look at this topic's 10-day volatility exploding higher this week. This is a chart that you can actually find on the terminal. And of course, not surprising given the wild gyrations on the topics. We were down more than 12% on Monday, gained more than 9% on Tuesday, gained more than 2% on Wednesday. Then we lost about 1% in the previous session. Where will we end up today is, of course, a big question. More traders in Japan turning to the safety of companies seen as best positioned to ride out uncertainty. Senior Asia stocks reporter Hideyuki Sano joins us for more on this. And Hide, I'll start you off with a bet perhaps between the two of us. Are we ending ending the week up or down? Because we're almost kind of there right now.
Yeah, so that's a very interesting point to see today. I wouldn't say it's certain that Nikkei is going to recover its huge losses it made on Monday. But I mean, if you look at the futures prices, it's getting close to last week's closing level. So that's possible. And if that happens, and if the Nikkei manages to fill the big chart gap, that sends a very strong, well, not very strong, but certainly that would improve market sentiment if you think that the market can recover so quickly. That's generally positive.
But at least what we know for now is that there are perhaps some winners within the broader stock market and some definite losers as well.
Yeah. The market has been so volatile, so it's hard to tell what is signals from noises. But having said that, I think one trend we might be starting to see is that some investors might be starting to shift to so-called quality stocks, basically companies that have steady earnings growth or small volatility in earnings or strong balance sheets, basically very strong companies. And the shares of those stocks are outperforming. Not that they are rising spectacularly, but they're doing better than others, and that sort of makes sense because during the past few years, basically the drivers of this rally in Japanese market are so-called value stocks, and the companies that are not doing very well in terms of earnings, but because of this strong focus on corporate governance, basically investors bought companies that have higher potential to do better in the future rather than companies that are doing well right now.
And also not to mention that, of course, there was a lot of optimism that perhaps the Bank of Japan wasn't going to move, that we were going to see easy conditions forever, and sort of that idea has been shattered.
Yeah, exactly. That surprised, I guess, quite a lot of investors when the BOJ said interest rates will be rising perhaps beyond this level. And again, I guess that's a wake-up call to investors. Interest rates can't stay low forever. If you expect inflation is going to stay at 2%, then obviously you can't keep interest rates near zero forever. So I guess in a way, the market is coming to the conclusion that if you believe in this inflation story in Japan, then I guess it's a matter of time that the BOJ will have to raise rates.
Senior Asia stock reporter Haidi Kasano there. Let's get you the latest on the corporate front. And Eli Lilly is narrowing the gap with rival Novo Nordisk in the race to dominate the obesity market as it expands its supplies of weight loss drugs. Lilly reported $1.2 billion in second quarter sales of Zepbound, smashing Wall Street's estimates of $819 million. It now expects full year revenue of up to $46.6 billion. That's up from its earlier guidance of around $44 billion. We've learned that Barclays has become the latest bank to remove a limit on some of its top bankers' and traders' bonuses. An internal memo seen by Bloomberg shows the company's so-called material risk takers can now earn bonuses of up to 10 times their base salary. Goldman Sachs and JP Morgan made similar moves earlier this year. Cloud computing startup CoreWeave is hiring senior executives from Google and Oracle to help build out its AI infrastructure. Chen Goldberg will become the senior VP of engineering, while Sachin Jain will serve as COO. CoreWeave has become one of the most valued startups in the AI boom, raising $12 billion in debt and equity over the past year. Well, Apple is said to be planning a new version of the Mac Mini that will be the smallest desktop computer yet. Sources say it will mark the first major design change to the product since 2010. Bloomberg technology reporter Mark Gurman joins us now. So what are we expecting here, Mark?
So Apple is getting a Mac makeover. They're going to be bringing a new chip to all of their computers, right? That's the M4 chip. This uses artificial intelligence or is able to process AI at faster speeds and more accurately than the current chips. And one of the first Macs to get this new chip will be this revamped Mac Mini. This is the first design change to the Mini in 15 years. This will be the third design change in the history of that product. It was originally introduced by Steve Jobs around 2005 for $500. The idea was you buy this computer, you hook it into your existing keyboard, mouse, and display. It doesn't come with any of those necessary accessories. And so now they're going to revamp it around this chip, and it's going to be much speedier than the prior one, and it's going to be less than half the size, and it's going to be about the size of an Apple TV set-top box. So this is going to be a really nice machine for anyone who needs something for creative work, for email, for Facebook, what have you. Not heavy-duty stuff on the M4 version. There's also going to be an M4 Pro version for video editing and the likes, but I think this is going to do well.
When can we expect it to hit the market, and also what sort of expectations are there for consumption on this product right now?
So the regular version, the M4 version, that's going to start shipping from suppliers overseas later this month to Apple warehouses. The M4 Pro version, the higher end version, is going to begin shipping to Apple from suppliers at some point in October. So based on all that, I would say that these machines won't be introduced and go on sale until that same month, October. The M4 versions will be, easier to get your hands on. There may be a little bit of a delay to get the M4 Pro versions. The Mac generates between $6 and $7 billion a quarter for Apple at this point. I think this new Mac Mini will keep those sales afloat, but in terms of growth, I think it's going to be negligible because of this machine.
Yeah, because we have seen Mac demand really slow, after people return to the office and post-pandemic, right? What is Apple really kind of relying on or hoping is going to be the next big thing, the next part of, the next super cycle maybe, to be able to really reconsolidate some growth here?
Well, I have bad news for some of the analysts that have talked about a super cycle. There's no super cycle coming. There's no super cycle coming this year. The iPhone 16 Pro is not a significant upgrade over the iPhone 15 Pro. Apple Intelligence is not going to drive any growth of significance in sales for the holiday period going into 2025. So if you believe that, I would reset expectations. Instead, these features are going to keep the sales flowing. It's going to keep the sales probably flat. Worst case scenario is a drop. I don't necessarily expect that. It was interesting in their guidance that they gave for the fourth quarter, which is when the new phones are going to go on sale. They didn't talk about any iPhone unit growth, right? Leads me to believe they think it's going to be flat too.
Bloomberg technology reporter Mark Gurman there with the latest on Apple. We have more ahead on the Asia trade. This is Bloomberg. India's Adani Group has told Bloomberg it's confident of meeting a 7-year deadline to revamp one of Asia's biggest slums. That's despite a threat from the main opposition party to halt the project if they win this year's state elections. In the last of 4 of our exclusive interview series with the Adani leadership team, we meet the family member in charge of the group's most complex and high-profile project.
This is Pranav Adani, nephew of billionaire Gautam Adani, one of the most powerful and controversial figures in Indian business. He probably looks out of place walking through Dharavi, which is Asia's biggest slum, located in India's financial capital, Mumbai. But he's visiting this area made famous by the movie Slumdog Millionaire because he's leading one of the most challenging projects the Adani Group has taken on. Pranav is spearheading the redevelopment of this network of makeshift shelters and structures, which is home to about 1 million of the most disadvantaged people in the city. The Adanis see developing the area as key to Mumbai's evolution as a modern city. However, many who live here worry they'll be left without homes and livelihoods. They fear they will have to move out of their houses and close their businesses to make way for modern apartments, offices, and malls. Bloomberg's Anto Antony asked Pranav Adani in an exclusive interview about the challenges the controversial redevelopment poses for the Adani Group.
It looks like a very complex project to execute because there are so many socio-economic challenges. How are you planning to go about it?
Dharavi project is, of course, a challenging project. It's a project that since the last almost 4 decades, different governments have been trying to redevelop. Finally, now they've been able to do it. We were very aggressive while bidding. We bid almost 2 times, twice the second bidder that we had over there. While yes, it is a good financial project, but at the same time, what is important to us is the kind of purpose that we will be able to do for a project like this. The purpose to be able to change the lives of almost 1 million people. And I can also tell you that it's a project like this which will really help us build the legacy for the Adani Group.
You knew that there would be political opposition and protests and so on related to this, and we are seeing some of it play out. Now, are you having a rethink, or are you sure that you will be able to finish the project on the timelines decided?
Oh no, now we are double confident, because at the end of the day, when we talk to the people at the ground level, those are the people who are really wanting the change. Those are people who are really waiting for a better life. We are talking about almost 3rd generation people who are wanting to see a change in their lives, getting out of this inhuman conditions, and they said that they are fully supporting us.
But not everyone is taking the Adanis at their word. As Pranav walks the narrow passages that connect the dwellings, accompanied by his security team, residents approach him with their concerns.
Everyone should get a room over here only. Do not shift us other anywhere, like Oilpen or Victoria or here and there. All our people must get here only room, and we must be satisfied. Give us some letters. What do you want in the letters? That you are giving us or no, or you are going to do you want, okay. You should provide people's letters.
Pranav is confident that the group will complete the Dharavi redevelopment project in 7 years. But it's not the only thing on his plate. Pranav, who is the son of Gautam Adani's elder brother Vinod, is in charge of the group's most consumer-focused businesses through joint ventures with food processing giant Wilmar and French energy major Total.
He was in BMC before that.
He's also responsible for protecting the Adani brand, a role that's attracted fresh scrutiny since the group was accused of fraud and stock manipulation by the short seller Hindenburg Research last year.
As the senior most among the 2nd generation leaders, what could you have done differently to avoid the kind of allegations which were posed by Hindenburg?
So I think, yes, there were learnings, I would say, from the whole Hindenburg episode. As a group, we have always been very focused on operational excellence, on execution. There are times when we have missed out in the kind of communications that we should do to our shareholders, to media in particular. Now, from an optic point of view, we have become very clear that we go out and communicate more transparently about the structures and about things like the finances. In particularly, I don't know if you lately heard that we are also very clearly working towards bringing down the EBITDA to debt ratio. So now we are getting our ratios also, and we are going out communicating more.
I think the Hindenburg allegations in the report caught you or caught the group kind of by surprise. So if a situation like this comes up again, how will you manage that differently?
Like I said, there was a lot of learning that happened during the Hindenburg episode. And now I think as a group, as a team, we are very well equipped to fight any such situation that comes in future. One is, very clearly we should try and make sure that nothing like this comes in. But now the systems are set up in such a way that in future ever, if there is any such financial attack on us, we are much better equipped through resources.
There are accusations and allegations that the group's surge in market cap, the jump in the family's wealth, is due to its relationship with Prime Minister Narendra Modi. When you talk about crony capitalism, in India or in this part of the world, Adanis is one name that keeps coming up. So it also kind of reflects in the way the stocks are volatile when election results come out. How do you assuage these concerns?
See, again, these are issues that have come up in media or by vested interest, frankly. As a group, we are in almost actively in 24 states. We are invested in 24 states out of the 28 states in India. And when I say we are invested, that means we are heavily invested, whether it is infrastructure, whether it is energy, whether it is resources, we are actively involved. Now see, any time when you have large investments in any state, it has to be aligned with the priorities of the state. Yes, of course, we are close to all the leadership of the state with different political parties. It is not that only one political party is running all the states. Different political parties are there across all the states, and we are close to them. Don't forget, whenever they do this investors summit, they actually come and invite us to come and invest in their states. So of course, when you're doing any large project, you have to be close to them. We are also invested in a lot of neighboring countries. Now, when we enter any neighboring countries, besides financial decisions that we take on the project, how good they are, we also look at what that host country requires. Whether it's infrastructure, energy, resources, we are aligned with those countries' national priorities. Then the most important is the strategic interest of India also should be aligned. So when all those three aligns, I think this is the best investment strategy. So I think it's false and incorrect to say that Adani Group is only invested or is only looking at where the present party is invested.
Pranav Adani, who runs the Adani Group's consumer businesses. And our exclusive coverage inside Adani continues later with a special report that's coming up at 11:30 a.m. Friday, Hong Kong time. There's an encore presentation at 7 p.m, 4:30 in the afternoon if you're watching in Mumbai. More ahead on the Asia trade, this is Bloomberg. Some of the other stories we're following this hour. Nobel Prize-winning economist Muhammad Yunus has been sworn in as a chief advisor of Bangladesh's interim government. His initiation comes after student-led protests forced Prime Minister Sheikh Hasina to flee the country. The opposition is now pushing for elections within the next 3 months. The last interim military-backed government stayed in power for 2 years. The US, Qatar and Egypt are calling for Israel and Hamas to resume ceasefire talks on August 15th. The framework for a truce will be based on principles outlined by President Biden, including a complete halt to all fighting and a prisoner exchange. Iran says Israel must agree to a Gaza ceasefire to reduce tensions in the Middle East. The Russian military is battling to repel Ukrainian forces from the Kursk region after one of the largest cross-border incursions of the war. The Pentagon says the move is consistent with US policy after reports the incursion involved armoured vehicles supplied by Washington and its European allies. Sources say Russia's army chief is now under growing pressure after seemingly dismissing intelligence warnings of a possible assault. We are seeing some of the risks sort of coalescing around oil prices at the moment. Oil is poised for that weekly gains with a lot of focus on the Middle East, as well as, of course, how we see this recovery from the global equity meltdown. A 3-day rebound, and we're now seeing kind of a bit of a steadying, about 1% higher when it comes to trading in WTI. Those developments in the Middle East, the sort of rally that we've seen in wider markets being very closely monitored. We saw Brent, of course, tumbling at the start of the week to near $75 a barrel for the first time since January, but we have seen that recovery then. But futures, though, looking to hopefully end that 4-week run of declines. We had the halting of the biggest field in Libya, as well as a 6-week of US stockpile draws, as well as some geopolitical tensions, of course, with Ukraine's incursions into Russia, just kind of compounding the overall sense of bullishness. Shery.
Yeah, at least in a couple of days, though, it's all been about that risk on sentiment back in the markets, right? Because when it comes to the S&P 500, we actually just saw its best day since November of 2022, and that really helping market sentiment around oil as well. Take a look at U.S. futures at the moment, continuing to gain ground in the Asian session, and really all to do with that eco data that we saw overnight. U.S. initial jobless claims declining by the most in nearly a year. So perhaps really allaying fears that we may be headed towards a hard landing, that the labor market may be cooling too fast. It might be just that we're returning to pre-pandemic trends. So Treasuries dropped across the curve, though. Swap traders now trimming bets on aggressive Fed easing this year. Take a look at how we're setting up for the opens across Asia right now, because it's really to do with the Japanese market and that roller coaster ride that we saw, not only on equities markets, but also in the Japanese yen, continuing to weaken against the U.S. dollar right now as we're digesting where the BOJ might go from here. 3/4 of global carry trades have now been unwound, according to JP Morgan. But really, all of this volatility in the currency space has led to volatility in the equity space as well. Take a look at the Topix Volatility Index, which has really exploded this week. We'll continue to watch if it's a down week or an up week, because we're very, very close to levels that where we started the week on the Nikkei. The market opens in Tokyo, Seoul, and Sydney are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens after that rally that we saw on Wall Street, Haidi, with the best day for the S&P 500 since 2022. And it's really all about eco data, isn't it? Because initial jobless claims falling by the most in nearly a year, reassuring markets that perhaps the economy is not cooling too fast.
And Shery, it has just been a roller coaster ride of volatility, of changing expectations, and it feels in a lot of ways we're sort of almost back to where we began. But obviously, it seems like it's going to take some time for this market to return to pre-sell-off levels of comfort when it comes to volatility. Right, there does still seem to be that fragility, particularly when it comes to Japanese assets.
We'll need to have a bet right now, Haidi, with you on where we end the week on the Nikkei and the Topix, because as you said, we're almost back to levels where we started after that huge plunge on Monday. But take a look right now, U.S. Nikkei futures at the moment and Topix futures pointing to the upside. I'm sorry, I keep saying Topix futures, but no, we have started trading. It's already the market opens. But this, of course, after we saw that incredible volatility throughout the week. So if we continue with these gains, we might end the week where we started. The Japanese yen, though, continuing on its downtrend. About 147 is the level right now, still about 8% higher against the U.S. dollar since its July weakness, where we saw it around that 160 level, right? And we continue to watch JGB yields as well, of course, because we had seen better than expected demand when it comes to auctions in government bonds. But we'll continue to watch where the BOJ goes from here, because we got those dovish signals that perhaps the BOJ is not ready to hike again if the markets stay unstable. Suffice it to say that we're watching the Japanese yen very closely because those global carry trades, and JP Morgan now saying that 3/4 of those global carry trades have been unwound. Take a look at how the Kospi is coming online right now, because we are seeing a little bit of a divergence. There we go. Higher, the Kosdaq, tech heavy, up more than 2%. This coming after the first loss in about 3 days, and also ahead of a day heavy on earnings. We have the likes of KT and Naver also announcing results today, Haidi.
Yeah, take a look at how we're trending when it comes to the start of the cash open here in Sydney. The ASX up by just about 1/4%. Again, like Shery mentioned, just sort of picking up on that lead and the positive sentiment, a little bit of the relief rally really coming through here. Of course, it's a little bit different when it comes to Australia. There is still that sort of expectation that we're quite far off from any RBA easing, but certainly that broader rebound looks to benefit here as well. The Aussie dollar is holding pretty steady, 65.90 at the moment. The Aussie dollar looking potentially to benefit as when it comes to sort of the unwinding of the yen carry trade and things start to come down just a little bit there as well. We are watching for some of these numbers out of the insurers in particular, QBE Insurance coming through with First Heart Net doubling. So that could see a bit of a reaction as they come online a little bit later in this alphabetic open here. We are also watching Treasuries, given the big sort of turnaround that we've seen for US Treasuries, yields sort of rising after those jobless claims numbers, the poor auction demand, that continuing to play out here as well. We are also watching to see that turnaround and whether it will hold when it comes to more risk on sentiment for oil as well. Some of this is sort of demand side. Some of it is obviously what we've seen with some of the Middle East tensions as well and broader geopolitical tensions. But oil is poised for that weekly gain with a number of those elements at play, including just that broader sort of optimism over the broader risk rally recovery. But of course, it is really down to central banks and what we've been sort of awaiting in terms of hearing from the Fed, from other central banks there as well. We did hear from one Fed speaker who says the Fed has time to assess the economy and determine their response. Bank of Richmond President Tom Barkin talking about, there is still some ways to go whether to consider the economy is normalising or softening and what the policy response would be from that. Take a listen.
I think you've got some time in a healthy economy to figure out whether this is an economy that's gently moving into a normalizing state that will allow you to, in a steady, deliberate way, normalize rates, and stick the landing, if I can use another balance beam analogy. Or, is this one where you really do have to lean into it?
Let's bring our next guest, who remains pretty positive when it comes to global equities. And in fact, they've increased their exposure to global equities. With us now is Roger Bacon, who's a head of investment advisory for Asia at Citi Private Bank. Roger, so I am wondering if your view is largely unchanged from, say, a week ago or a week and a half ago, or has the sort of sense of a little bit more value returning to this market made you more constructive, given that we're now kind of trending back to levels almost before all of this happened?
Well, it's certainly been quite a week, and thanks very much for having me on the show. I think if I'd been here on Monday morning, my hair would probably have been on fire. But things have certainly calmed down a little bit since then. But we've got a lot of problems ahead of us and a lot of things to try and navigate, and that's obviously the crucial thing for us as we go through each of the trading days. And we are in much better shape. As you've mentioned, we have increased our exposure to global equities on the back of this. So we are now about 4.5% overweight global equities. And we have paid for that by reducing our fixed income exposure at the global level, where we're now slightly more underweight, having reduced our exposure to US Treasuries, long duration US Treasuries. We still like things like preferred, we still like bank loans a little bit at the expense of high yield and EM sovereigns. So a little bit of mechanics or movement within the fixed income space. And on the equities side, yes, as I say, we remain overweight. We like large cap equities. We are neutral on small cap and mid cap equities, although we prefer US small and mid cap equities over ex-US small and mid cap opportunities. So there's a lot, of course, going on at the moment, but all eyes on Japan, which is not something that we've talked about much over the last 25 or 30 years. Now Japan is very much center of the plate, so very important to see how things develop there, and particularly some of the commentary, some of the rhetoric coming out of the Bank of Japan at the moment, where clearly they have been, I think it's fair to say, slightly surprised by the extent of the market reaction, by the impact of this huge unwind of the global carry trade, which we've seen reported.
Which, according to JP Morgan, about 3/4 of that is now unwound, hopefully not too much pain to go. The communication over central bank decisions is interesting, right? Because it feels like they're tripping up a little bit. Even the Bank of Japan, Governor Ueda came across as hawkish with that decision. The decision itself was seen as hawkish because it was unexpected. And yet in the minutes we see, they didn't see it as meaningful tightening. So are we at risk of further kind of communication mishaps here for these markets, and therefore we should be bracing for further bouts of volatility, particularly when it comes to Japan?
Well, that's absolutely right, and the central banks around the world have to be very careful with what they're telegraphing and then what ultimately they're messaging as they make changes, and particularly in the case of Japan, where you've had this very sort of, let's call it, static policy for so many years, and then suddenly you have this inflection point. And people really just not ready for it, even though to an extent it had been telegraphed for a few weeks or even a few months. So I think that's the challenge for central banks going ahead. And, the two things that we've learned over the last week, the first, of course, is the huge sensitivity to central bank activity by investors and allocators around the world. The second one is a newer phenomenon, and I referred to it earlier, which is the extent to which the carry trade, or the impact of the carry trade, has a major impact on sentiment as well. And when we look back to the beginning of the week and we see Japan, the market down about 12% in the day, and Taiwan down 8%, these obviously are very challenging moves, and our job really is to help our customers navigate through this, to look through some of the noise and really address what has changed with the fundamentals at the individual company level, the individual security level. So that is ultimately the challenge for us at the moment. But I think volatility obviously has spiked. I think we saw the VIX go up above 70 intraday. Earlier in the week, it's now come down dramatically. So we've seen people that were historically buying volatility when it was at very low levels, between 15 and 20. And then as the VIX went up, 65, 70, starting to sell volatility. And that's obviously been a very interesting trade as well. So a lot of moving parts.
I want to get to those quality companies, especially here in Japan. But before I get there, just because of this point that was raised earlier about BOJ communications, as an investor, what do you want to see from Governor Ueda? Because it's been really interesting that we've pinpointed to the BOJ rate hike, but it was really just after the U.S. jobless numbers last week came out, weaker than expected, that sent all this volatility and the financial meltdown this week. So I wonder how much it has to do with how the BOJ has been really carefully trying to choreograph the message to just not really being able to help what happens with external factors with the global economy in the U.S.
Well, I think they may have learnt a few key points over the last few days. And obviously, the BOJ has not really been the centre of attention at the global level as it has been for the last few days. So lessons to be learned clearly around their communication, how much they can telegraph, how explicit they can be. But they've now seen the implications of when a number of negative news points, including the job data coming out of the US at the same sort of time, they can see the major impact that it has on sentiment and obviously on markets day to day. So going forward, obviously, the communications that they have will be critical. We'll be looking for, to answer your question, we will be looking for as much telegraphing as possible, whilst reflecting on the fact that the underlying data is changing in real time, and they have to be able to adapt their stance as that data develops. So it's a very difficult challenge for them. But ultimately, as an investor, what I would like to see is the maximum amount of advance warning, and then we stick to the plan. And there have been a number of examples over the last several years where the plan hasn't been stuck to, and you see these very rapid shifts in sentiment, which obviously cause major sell-offs in the market, which is not really what anybody wants.
In the meantime, while we're deciphering BOJ communications, how do you hedge that? Is it all going into more quality companies, even here in Japan, if until now the rally in the past year had been just overall a general rally? Where do you find the quality names?
Well, quality is one thing, valuation is another. And we've had to reassess the fundamental case for every single name, basically, over the last week. Obviously, there are areas of the market which have structurally been very weak as a result of the implications of this central bank activity. So when you look at specific areas, Japanese banks at one point selling off over 20% on the day, recovered a little bit. From a valuation perspective, they start to look very interesting. But at the same time, if we don't know what the trajectory is for interest rates, will banks benefit as much from an increasing rate cycle as we were expecting beforehand? Because if rates don't go up as much as were previously expected, then obviously they won't be as much of a beneficiary as they might otherwise have been. And we're talking very incremental steps here. We're talking 25 basis points here or there over a long period of time, but it has major implications, obviously, for the earnings of Japanese banks, which we're used to in the West when we look at the performance of banks and the sensitivity to interest rates. Obviously, in Japan, that's a new thing for us to be looking at. And then more broadly across the market, really a question of those companies, of identifying those companies that will benefit from a change in the rate policy in Japan, those that have got pricing power, those have got the ability to generate supernormal earnings momentum from here, hopefully. Obviously, valuation support is an important part as well. But ultimately, the sensitivity to rates is an important factor when you're picking individual names in that market. And that really is what we should be doing as fundamental investors. And when you think about if you like a stock at 100 and it goes to 80, you can either say, oh my God, something has changed, I need to sell it off. Or you say, well, actually, the fundamentals haven't changed. But if I liked it at 100, I like it even more at 80. Let me take that opportunity to build my position more. And that's what you need to do at a very surgical and prescriptive level, almost name by name in the portfolios, which is very labour intensive. But ultimately, it gives you the rigour around risk management, which is so critical to managing client portfolios.
Roger Bacon, good to have you with us, Head of Investment Advisory for Asia at Citi Private Bank. As we continue to watch these market gyrations, we're now seeing SoftBank gaining ground. We're talking about jumps of about 9%. And remember, this is a company that has gone through a roller coaster ride just this week, especially after unveiling the $3.4 billion buyback. They had earnings this week. They actually fell in the previous session while they're up about 9%. But remember, the Monday rout wiped out about 19% of that stock. So we'll continue to watch this as we also get more earnings later in the day. This is Bloomberg.
China's July inflation data is due later this morning. Let's get to our China correspondent, Min Min Lo, who joins us in Hong Kong with a preview. So, Min Min, what are we expecting here?
Yeah, we're still seeing very persistent pressure on prices. Consumer prices expected to hover just above zero. Producers' prices expected to decline by 0.9%, and that is the 22nd straight month of decline. And that drop in factory gate prices is cutting into the profit margins of manufacturers. And you're seeing overseas demand for Chinese goods beginning to soften, judging from that weaker than expected print in the July exports number. You have potential U.S. recession on the horizon, and domestically, consumers are not picking up, not filling that gap as well, even though the government has been prioritizing measures to boost consumption, rolling out that 20-point plan that was announced by the State Council just recently, and the expansion of that equipment upgrading program as well. There are still persistent fears around the state of the economy, income growth, and falling home prices as well. That's a big one that is preventing people from opening up their wallets.
And that's been a real concern, especially for the luxury sector, right? What are they consuming now with, the hesitancy still about the broader economy?
Yeah, so what we're seeing is a shift in consumption trend from spending on goods to spending on services. And we're talking about bespoke, personalized services as well. And that's why you're seeing the luxury brands like LVMH, their sales are not doing so well. But you're seeing a travel boom when it comes to the national holidays. And even if people don't have a lot of money to spend, they're still going out to the tier 2, tier 3 cities. They're going to villages to experience rural tourism, a different way of life. They're picking up a new skill, new sport, and that's why paddle boards and other sports equipment sales are picking up as well. And this is where we see a lot of upside potential when it comes to services, because China's share of services consumption, if you look at that chart, is still quite low. It's at 50% of GDP compared to around 75% for countries like the US and areas like the EU. So a lot more room for growth, and that's why China's plan to boost consumption, that 20-point plan, was largely focused on nurturing services consumption in areas like dining and accommodation and travel. And per capita spending now is still below pre-pandemic levels, which shows again that, there is a bit of that downgrading of consumption. There's still room for people to spend more, especially when the confidence comes back in the economy.
Bloomberg's China correspondent Min Min Lo there. And of course, the economy also key when it comes to the presidential election in the U.S. Battleground states in this year's race are showing economic cracks that could prove a political obstacle for Democratic candidate Kamala Harris. That's the subject of today's Bloomberg Big Take. For more, let's bring in News Desk editor Jill Deasy's. Jill, of course, it's really all about those local economies and how voters feel, right? So how are these major battleground states performing? Good news for Trump or Harris?
Yes, Shery, look, really, it's probably better news for Trump at this point. As we know, the U.S. election isn't decided by the national popular vote. It's decided by those votes in each of these states, building up to what you can ultimately amass in the Electoral College. And so what that ultimately comes down to are these battleground states. And what we're seeing from a lot of this data that we've really compiled is that when you look at some of these really critical battleground states, the blue wall particularly, looking at Michigan, Pennsylvania, Wisconsin, states like that, actually the GDP per capita in those states, the combined growth from 2019 to 2023, this really critical period during the Biden administration, really, is just in the end of the Trump administration, it's just a third of that of what you'd see outside of swing states. And so the broader picture here is that even if the national economy is doing pretty well, doing okay, it doesn't really feel like that in a lot of these major counties where you would ultimately expect, people to, kind of turn out and vote for, a candidate that may swing the election. So when we look at like Pennsylvania, for example, we actually went to Erie County, Pennsylvania, kind of a critical, piece of that state there, piece of that story. And the story there is that even if there's been some significant investment projects there, it hasn't really translated into something that actually feels like real meaningful growth now. And so that could be a real trouble spot for somebody like Kamala Harris at this point if she's looking to win over that state and then ultimately win the election in November.
Trump and Harris have agreed to one debate. There could be more.
Yes. So at this point, it seems like that ABC News debate in September is back on the table. Trump just held a big press conference at his Mar-a-Lago resort in Florida, where he did say that he agreed to that one. He also floated a couple of other debates on Fox News, NBC News. Doesn't seem like the Harris campaign is, agreed to that yet. But this is a real pivotal moment for Donald Trump. I mean, he's really lost the narrative over the last couple of weeks after Biden dropped out of the race. Kamala Harris came in. She's really seen sort of this groundswell of support kind of come up. Polls are starting to tip a little bit more in her favor. So if you're Donald Trump, you really want to pull the narrative back. You're probably looking at that debate between Trump and Biden was so disastrous for Biden that he ended up dropping out of the race. So at this point, Trump really kind of needs to do what he can to bring attention back to him. At this point, we'll see what ultimately happens with this at least one agreed upon debate in September. We'll see if there's actually any more after that.
One of those comments that he made at Mar-a-Lago was that the president should have a say when it comes to interest rates. Take a listen.
I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
What would an economy again under Trump look like? What are some of the economic factors that we should be watching out for?
Sure. Well, I think those comments that you just heard from Trump there about the president maybe having a little bit more control over interest rates, that's not entirely different from a lot of what he said before. I mean, we've heard, Trump kind of lambast Jay Powell, chairman of the Federal Reserve, who, point out that he appointed there. But there's been some, talk from Trump over the years about how maybe the president should have more influence. That's obviously not exactly how the Federal Reserve works. And Jay Powell has made a point of saying that, he wants to preserve the Fed's independence there, but not really that surprising because, Trump would obviously want, to kind of, turn things a bit in his favor, in his political favor ahead of the November election. We'll ultimately see, whether that would translate into some kind of action, were Trump, to assume another term in office. It all comes down to, whether or not he's able to actually reclaim the presidency come this election.
Our news desk editor Jill Dasis there. Subscribers can read more on that big take at the terminal or by heading over to Bloomberg.com. More ahead on the Asia trade. This is Bloomberg. Let's get to some of the market calls that we're tracking today. And JP Morgan strategists say US stocks could be headed for more severe declines. That's if the economic growth picture continues to decelerate and the Fed does not show any urgency in easing monetary policy. Strategist Dubravko Lakosbuya adds that traders' focus have now shifted from inflation to growth risks. This marks JP Morgan's first note to clients following the departure of their former chief global strategist, Marko Kolanovic. The world's biggest active bond fund manager says he's just about ready to start adding to Treasury positions again. Daniel Evanson manages the nearly $160 billion PIMCO income fund and had trimmed some holdings in recent weeks as US bonds rallied sharply. But he now says renewed market turbulence combined with softer economic data and crowded trades make bonds, Shery, a good defensive play.
And take a look at some of the big movers in today's session. We're watching Tokyo Electron, big gains after they revised up their forecast. They're seeing AI demand really helping sales beat. We're also watching, for example, other names such as Panasonic because they're cut their EV battery output target by 30%. This is according to local media. And we had seen, of course, their first quarter operating income missing estimates. But suffice it to say, but for this session, it's really all about those gains, the broader gains in the Nikkei on the topics as well. We're potentially at similar levels where we started the week. You're looking at Nikon, which is down at the moment despite the fact that they boosted their full year net sales forecast as well. This is Bloomberg. India's Adani Group has told Bloomberg it's confident of meeting a 7-year deadline to revamp one of Asia's biggest slums. That's despite a threat from the main opposition party to halt the project if they win this year's state elections. In the last of our exclusive interview series with the Adani leadership team, we meet the family member in charge of the group's most complex and high-profile project.
This is Pranav Adani, nephew of billionaire Gautam Adani, one of the most powerful and controversial figures in Indian business. He probably looks out of place walking through Dharavi, which is Asia's biggest slum, located in India's financial capital, Mumbai. But he's visiting this area made famous by the movie Slumdog Millionaire because he's leading one of the most challenging projects the Adani Group has taken on. Pranav is spearheading the redevelopment of this network of makeshift shelters and structures, which is home to about 1 million of the most disadvantaged people in the city. The Adanis see developing the area as key to Mumbai's evolution as a modern city. However, many who live here worry they'll be left without homes and livelihoods. They fear they will have to move out of their houses and close their businesses to make way for modern apartments, offices, and malls. Bloomberg's Anto Antony asked Pranav Adani in an exclusive interview about the challenges the controversial redevelopment poses for the Adani Group.
It looks like a very complex project to execute because there are so many socio-economic challenges. How are you planning to go about it?
Dharavi project is, of course, a challenging project. It's a project that since the last almost 4 decades, different governments have been trying to redevelop. Finally, now they've been able to do it. We were very aggressive while bidding. We bid almost 2 times, twice the second bidder that we had over there. While yes, it is a good financial project, but at the same time, what is important to us is the kind of purpose that we will be able to do for a project like this. The purpose to be able to change the lives of almost 1 million people.
Pranav is confident that the group will complete the Dharavi redevelopment project in 7 years. But it's not the only thing on his plate. Pranav, who is the son of Gautam Adani's elder brother Vinod, is in charge of the group's most consumer-focused businesses through joint ventures with food processing giant Wilmar and French energy major Total. He's also responsible for protecting the Adani brand, a role that's attracted fresh scrutiny since the group was accused of fraud and stock manipulation by the short seller Hindenburg Research last year.
As the senior most among the second-generation leaders, what could you have done differently to avoid the kind of allegations which were posed by Hindenburg?
So I think, yes, there were learnings, I would say, from the whole Hindenburg episode. As a group, we have always been very focused on operational excellence, on execution. There are times when we have missed out in the kind of communications that we should do to our shareholders, to media in particular. Now, from an optic point of view, we've become very clear that we go out and communicate more transparently about the structures and about things like the finances. In particularly, I don't know if you lately heard that we are also very clearly working towards bringing down the EBITDA to debt ratios. So now we are getting our ratios also, and we are going out communicating more.
Pranav Adani there, who runs the Adani Group's consumer businesses. And our exclusive coverage inside Adani continues later with a special report that's coming up at 11:30 a.m. Friday, Hong Kong time. There's an encore presentation at 7 p.m, which is 4:30 in the afternoon if you're watching in Mumbai. We'll take a look at these Asian markets as we round out the week with the major markets trading for just about half an hour or so. And we are seeing quite a bit of upside with that rebound really following the positive session we had on Wall Street. Some of that data really kind of calming market jitters there. The decline in US initial jobless claims lifting broader investor sentiment. That rally in the S&P 500, of course, was the best session since November 2022. So we are seeing really that gain being seen across Japanese equities in South Korea as well as Australia as well, seeing more modest gains of about 0.6%. We're also seeing Hong Kong futures looking quite upbeat as well, Shery.
And we'll really be watching that Nikkei level of 35,909 because that's where we started the week before the Monday plunge. And one of the sectors that we are very much paying attention to is a bank index on the topics as well, right? Because it lost about 27% in the first 3 days of this month. MUFG is one of those companies that we're watching because we have seen it trying to invest in digital startups across Asia. MUFG will also acquire an 8% stake for $393 million on the digital payments company in the Philippines, Globe Telecom's GCash. So let's actually discuss the market when it comes to mobile payments to the Philippines' top provider, GCash, still keen on going public after its latest investment round pushed the fintech company's valuation to $5 billion. Joining us now is GCash President and CEO Martha Sazon. Martha, great to have you with us. So could you, first of all, I guess congratulations are in order, given, of course, all of these investments and commitments coming from investors. How much new capital will actually go to Mynt, the global fintech innovations, or the firm that manages GCash from the latest investments?
Well, thank you for inviting me here, Haidi and Shery. Well, first of all, last week we just announced our latest strategic investment from MUFG, and that's worth around 800 million combined investment from both MUFG and Ayala Corporation, one of the largest and most enduring conglomerates in the Philippines. That's a mixture of secondary and primary, although largely it's secondary actually. And the deal is the largest fintech transaction in Southeast Asia in the last 3 years and the largest fintech transaction in the Philippines ever.
So can we have sort of a breakdown of how much the new capital will go to Mynt and how Mynt is really thinking of deploying the fresh cash?
Well, as to the amount, we cannot divulge the exact amount. That would be the primary part. But in terms of the use of those funds, it would be largely for lending as we scale up our lending business. We will also be investing very much in our payments business, which has been our core and has been continued to grow in the past couple of years. So we will be going deep into lending as well and our expansion to the international business. So far, right now, we've already opened in 17 countries globally. So we continue to expand our presence internationally to serve Filipinos abroad.
Will you be seeking a digital banking license given the moratorium has just been lifted on new digital banks?
Well, that's being discussed, although nothing is definite as of the moment.
What else when it comes to fundraising then? Can I ask you about whether an IPO is being considered and if so, what's the sort of framework for timing?
Well, for the IPO, of course, that's always on the table. But our priority right now is really to grow the business and sustainably grow the business, which has been working for us as we focus on the growth. And also monitoring the market. Well, we've seen how the market has been the past week. So we will continue to monitor the market, and when the conditions are right, maybe we can consider IPO.
How enthusiastic are you about accepting new investors with the IPO sort of discussions aside, and what would you hope that they can add to the business?
Well, we just got our strategic investor right now. As we said, we're not really in need of funds right now because since 2021 we've been positive in terms of bottom line. But we got in MUFG and Ayala because they're strategic investors, and we know that they would contribute a lot in our growth agenda, particularly in lending business. In the case of MUFG, they'll be able to help us in terms of a cheap cost of funds when it comes to lending. Right. So in terms of new investors, we're not actively considering that right now as we're just in the process of closing this big deal.
Mm-hmm. You mentioned really growing your lending business. Can you give us a bit more details when it comes to the structure of your business? Say how much is really that sector, how much is actually mobile payments?
Oh, well, our lending business, we've disbursed so far 155 billion pesos life to date, and it's been growing 73% year on year. Our unique borrowers is at 5.4 million, and it's growing more than 70% again year on year. As to the type of lending that we give out, it's largely the G loan or the loan cash loan business. And we're more focused on everyday loans, small loans, rather than what the banks do. So we don't actually compete with the banks. Rather, what we compete in would be, who we compete with would be the loan sharks. In the Philippines, which is largely unbanked, and almost 50% are undocumented. Those who are in need are actually exposed to the loan sharks and usurious interest rates. So that's what we're trying to address with our lending business. So from AVPU to the frequency of the loans, it's really more everyday rather than the big ticket items.
We're seeing growing unease when it comes to the trajectory of the global economy, especially depending on where the Fed goes and where central banks around the world go. What's the outlook for your business considering the macroeconomic considerations in the Philippines?
Well, our business continues to thrive because we serve the underserved. And we continue to focus on our customers, and we see that there's a lot of opportunity for growth as we focus on financial inclusion. In the Philippines, even though we've managed to help the central bank to include as many Filipinos financially, like up more than 50% now, there's still a large part who don't have access to formal financial institutions, whether that's from savings to investment to other wealth management products, insurance, and most especially lending. So that in itself provides us with huge opportunity for growth.
What about just the
Martha,
interest
really
rate
great.
outlook right now when it comes to lending?
Come again, sorry.
What about the interest rate outlook, for example?
Yes, so on the interest rate, we're very conscious about managing the interest rates, whether the volatility of the interest rate, especially we're dealing with the lower eco class segment. So slight movements in the interest rates by the BSP or by the central bank, we don't necessarily reflect them to our offers to our customers.
Martha, really great to have you with us. Martha Sazon, who's the President and CEO at GCash. More ahead on the Asia Trade. This is Bloomberg.
Investors are turning their attention to Asia's emerging markets, which suffered less damage during this week's wild ride in global equities. Societe Generale is seeing a higher probability of rotation to China from Japan. India is also seen winning favor for its domestically driven market. Catherine Nye leads our Asia equities coverage and joins us now. So, Catherine, how are investors thinking about where to invest in Asia, given the big rotations, not only sectoral across the U.S., just within regions across Asia?
Right. Good morning. You know, this is such an interesting question right now. I think everybody is wondering what is possible given the rout that we saw and just amazing volatility in the sector. And you know, beyond just the question of whether it's AI or not AI, I think that investors in Asia are now looking to pockets of growth, pockets of immunity. And so, you know, we don't talk about Southeast Asia very much, but somehow Southeast Asia has become sort of a hotspot with Goldman this week, you know, upgrading Malaysia and also saying that, you know, they're in favor of India and Indonesia, areas where, you know, that they've become sort of less hit in the overall sell-off in the region.
So, you know, sector-wise, I guess what's attractive in Southeast Asia?
Right. So there is a lot going for Southeast Asia. You know, we think about for, I guess, on a broad-based level. I mean, I think Malaysia has been sort of a real winning story, not just for this week, but for much of this year. If you kind of look at where the benchmark has gone, you know, mind the little bit of hiccup this week. You know, a lot of people were bidding it up. They like the sort of policy stability with Anwar kind of going into the second year. They like a lot of the plays in terms of the real estate and such. For a while, people really liked sort of Singapore real estate, that and banks, which had been leading the way. That had been a really strong area. You know, Indonesia, I think one of the only markets in the green this week, which is quite fascinating. It's sort of got, you know, broadly a lot of banks and people like some of the sectors in the real estate plays as well. And so, you know, this is an area, I think, broadly speaking, kind of investors are saying, hey, this is, you know, an area that is under sort of not tapped, overlooked, has a lot of sort of good things going for it. It's finally sort of back in the spotlight in an area that people like.
China hasn't had many moments of market attractiveness over the past, you know, prolonged period, it feels like. But it is typically counter-cyclical when we see events like this. Is that appeal likely to stick, do you think?
Right. China is a tricky topic. You know, as you just mentioned in the beginning, Sakchen saying that we're expecting a lot of sort of a rotation away from Japan to China. Valuations are low. We know it's got huge companies, a lot of potential, but I think it's no secret. You know, people are worried about sort of the economic outlook for this area. There are pockets and areas where people are saying, you know, this is good. Tech is an area that's been overlooked for many years after the sort of the crackdown, the regulatory action that started sort of in 2021. People are saying, hey, tech looks like an attractive area right now, especially with earnings for some of the biggest tech giants next week. Property is still kind of a weak area here. China, I think, is going to be one of those, you know, enter as you will. There's risk ahead just because of the uncertain outlook. But in terms of at least on a valuation level and at least in terms of the defensiveness and sort of going the other way relative to the rout, I mean, China is definitely a standout.
Catherine Nye, who leads our Asia equities team there. And of course, we're watching for the PPI and CPI numbers for July, which is likely to show that risk of deflation still very much front and center for China this morning. More ahead, though, on the Asia trade. This is Bloomberg. Some of the latest corporate headlines that we're following. Eli Lilly is narrowing the gap with rival Novo Nordisk in the race to dominate the obesity market as it expands its supplies of weight loss drugs. Lilly reported $1.2 billion in second quarter sales of Zepbound, smashing Wall Street's estimates of $819 million, and now expects full-year revenue of up to $46.6 billion, up from its earlier guidance of around $44 billion, I should say. We've learned that Barclays has become the latest bank to remove a limit on some of its top bankers and traders' bonuses. An internal memo seen by Bloomberg shows the company's so-called material risk takers can now earn bonuses of up to 10 times their base salary. Goldman Sachs and JP Morgan made similar moves earlier this year. Cloud computing startup CoreWeave is hiring senior executives from Google and Oracle to help build out its AI infrastructure. Chen Goldberg will become the senior VP of engineering, while Sachin Jain will serve as COO. CoreWeave has become one of the most valued startups in the AI boom, raising $12 billion in debt and equity over the past year, Shery.
And Haidi, sticking with AI, investors are still trying to determine if the red-hot trade has reached an inflection point. The outlook could be brighter, though, for the biggest AI names in Asia. Let's bring in our tech reporter, Annabelle Drulers, to discuss. Belle, why is that the case?
Yeah, well, there's actually a number of different reasons, and it's quite a good time to be talking about it as well. Just the positivities, given you've got the Asia Tech Gauge actually looking at its longest run of weekly losses, rather, going back to 2022. Still, there's a lot of positives to be had, and one of those is just the outlook for names like TSMC, SK Hynix, Samsung. You're continuing to see those profit estimates climbing here, and it's quite an interesting difference that you actually see when you compare what's happening in Asia, the biggest chip names here, versus what's happening in the US, because actually the consensus has been lowered going back to July of this year. Even after the rout, for instance, we had this week, Morgan Stanley, for instance, was coming out and saying, buy TSMC, this is an opportunity to be getting in. That chart there, taking a look at the percentage change of EPS consensus going back to June of this year, and you can see it starting to peel off for the likes of Microsoft, Apple, Nvidia, Alphabet, but you see still a lot of positivity there for SK Hynix, Samsung, TSMC, these major chip names here in Asia.
Investors still hedging their bets, though, right?
Yeah, that's right. It's not all out of the woods just yet. And again, it's being expressed in a few different ways. But one of those is demand for protection, that you're seeing a further drop here for the likes of TSMC, Samsung. The volatility skew as well, that's another way that this is being judged for TSMC. That's actually now climbed near its most bearish level since May of last year. So a couple of different ways that again, as you say, investors are looking to hedge their bets. Still, though, the decline that we have seen in tech stocks over the course of this year, you can see AI stock valuations here below their 10-year average. It does actually put it in quite an attractive position from a valuation perspective. So again, really a lot of the investors we've been speaking to are saying that this is a key buying opportunity.
Our tech reporter, Annabelle Drulers there. Let's take a look at how we're setting up, particularly when it comes to some of those tech names, right, in the likes of Taiwan. We're watching TSMC in particular with the big move in ADRs. We can see quite a strong rally once we get into the cash session. But take a look at broader TAIEX futures, up by almost 3% at this point. We're seeing China futures actually posting a little bit of a gain there, despite of expectations that the inflation data is expected, in particular when it comes to the factory gate side, to continue to be in the doldrums when the July numbers come through later on this morning. S&P futures looking pretty flat at the moment, but maybe just taking a bit of a breather after, of course, that market notched the biggest rally since November 2022. It was really the US initial jobless claims numbers falling the most by nearly a year that kind of returned some calm and comfort to these markets. We also saw Treasury yields rising, really kind of dimming these bets on Fed policy easing there as well. So we are seeing, broadly speaking, that rally carry through to the Asian session, Shery.
Yeah, take a look at how Nikkei is trading at the moment, because we're very close to that 35,909 level, which would be the Friday close, right? So after that plunge of 12% on Monday, are we back to levels where we started the week? Well, it's all about the Japanese yen when it comes to global markets as well, right? Because it's continued to weaken versus the US dollar overnight. JP Morgan, though, saying that 3/4 of global carry trades now have been unwound, and Citi saying that he's actually watching the yuan because it's at risk of being squeezed. This is Bloomberg.